Welcome to the debate.
Thanks for joining us.
For our audience tuning in to this special Friday summary on the Voxaily News channel, specifically for our Morning on Voxaily program, we're directing our analytical lens toward an issue that is no longer just a geopolitical abstraction.
Far from it.
Right. It is a central pressure point hitting every single listener directly in their wallet right now. We are talking about the escalating Middle East crisis and its direct, tangible impact on everyday energy consumers globally.
Exactly. We are looking at a highly volatile situation today and asking a central question. Are global energy markets heading toward an unavoidable catastrophic price shock and prolonged stagflation? Or are systemic market buffers and, aggressive geopolitical interventions resilient enough to stabilize prices and shield everyday consumers from the fallout?
And our discourse today is firmly rooted in recent economic data, geopolitical statements, and market analysis emerging directly from the ongoing conflict. I will be arguing that severe supply constraints and unmitigated risks practically guarantee a prolonged inflationary crisis for energy consumers. The mathematical realities of physical oil being pulled from the market cannot simply be legislated or maneuvered away by politicians.
And I will argue that strategic market workarounds and aggressive international interventions are actively neutralizing these worst-case economic scenarios. While the mathematical risks my colleague mentions are undoubtedly real, we operate in a highly adaptive global system. The global markets, alongside major state actors, are successfully intervening to prevent consumer devastation, proving that, market resilience often outpaces catastrophe.
To build the foundation of my position, we really have to look at, the sheer scale of regional production cuts. We also have to look at the geopolitical risk premium. That's that extra cost baked into every single barrel of oil just because the market is terrified of what happens next. A severe economic hit to the consumer is, in my view, practically unavoidable at this stage. I want to point directly to the recent analysis by Dr. Abdulwahab Abukawi. He has issued a really stark warning. If oil prices push above the $120 per barrel threshold, it threatens the entire global economy with a severe recession.
Yeah, the $120 mark is definitely the psychological and mathematical tripwire for the global economy. Nobody is debating the danger of that threshold.
Right, and we are on a trajectory that makes this a very real possibility because of specific, undeniable supply shock data. Iraq has cut production from its southern fields by a staggering 70%. Let that sink in. 70% from one of the most vital regions in the global energy ecosystem. Simultaneously, the Kuwait Petroleum Corporation is gradually reducing its production. The math for the everyday consumer here is exceptionally bleak. Dr. Abukawi's models show that if oil simply stays above $80, inflation rises by 1% annually. If it hovers near $100, inflation will hit 3% by the end of 2026. Tapping into global strategic reserves to bridge this gap is fundamentally insufficient. It is a temporary patch on a massive structural supply crater. We are looking at an inevitable squeeze on the consumer.
I understand the gravity of those figures, and a 70% cut in southern Iraq is not something to brush past. But my position is rooted in the fact that the global system is far more elastic than those rigid models suggest. We are witnessing unprecedented, pragmatic exceptions being made by world powers specifically to keep global supply flowing and shield the everyday consumer. Look at the United States granting India an explicit exemption from sanctions to continue utilizing Russian oil. That is a highly calculated move, designed to maintain global liquidity in the energy markets.
It is a calculated move, certainly. But it doesn't replace the physical barrels lost in the Middle East.
It relieves the pressure, though. Furthermore, the stabilization of critical choke points is an active ongoing success story that the doom and gloom models largely ignore. Brigadier General Abdul Nasser al-Humaidi has confirmed that the Strait of Hormuz remains open, with ships flowing normally. This is not by chance. It has been aided by the systemic destruction of 90% of Iran's naval capabilities that could threaten maritime navigation. And we see European nations explicitly prioritizing their economic and energy stability over distant geopolitical conflicts. The UK housing ministers categorically deny that there will be winter supply shortages, while France is actively deploying anti-air defenses to neutralize threats to regional stability. The system is bending, it is adapting, but is not breaking.
I see why you think that, but let me give you a different perspective. You highlight market elasticity and sanction exemptions, but I really must emphasize the fundamental physical loss of crude oil. No amount of market maneuvering, diplomatic exemptions, or paper trading on Wall Street can replace the massive 70% reduction we are seeing from Iraq's southern fields, combined with Kuwait's simultaneous output contractions. We are talking about millions of barrels of actual physical product removed from the daily global supply. You can't refine a diplomatic exemption into gasoline.
No, but a diplomatic exemption ensures that the gasoline that is available gets routed efficiently without sparking a massive bidding war.
Even so, the sheer volume is the issue. And while tapping into strategic petroleum reserves is often touted by politicians as the ultimate safety net, energy experts unanimously agree that reserves are exactly that, reserves. They are fundamentally insufficient to solve a prolonged structural supply deficit. They are a Band-Aid on a hemorrhage. If the physical commodity is not being pulled from the ground in the Middle East at historical volumes, the everyday consumer will pay the price at the pump. And as we know, that price cascades into the cost of groceries, logistics, and basic goods. The inflation doesn't just stay at the gas station.
I come at it from a different way. Viewing the oil market strictly through the lens of localized physical cuts heavily underestimates the fungibility of global supply chains. Oil is the ultimate global commodity. When we say it's fungible, we mean that if one tap turns off, buyers just reroute their ships to another tap. It's highly adaptable. The specific United States strategy regarding India and Russian oil is the perfect counterexample to your fear of a structural deficit.
How does that solve the physical deficit from Iraq, though? India buying Russian oil doesn't magically produce more barrels.
But it doesn't produce more barrels, but it drastically shifts the demand curve. By allowing India to buy Russian oil without facing secondary sanctions, the United States effectively takes India, one of the world's most massive energy consumers, out of the bidding war for Middle Eastern crude. That leaves whatever oil is coming out of the Middle East, even at reduced capacity, available for Europe and the West. Here you have a superpower willing to bend its own strict sanction rules specifically to prevent the exact global stagflation scenario you are warning about. Why? Because global leaders understand that allowing the market to suffocate is political and economic suicide.
But that level of pragmatism has its limits.
This level of extreme pragmatism is the buffer. It directly protects the everyday consumer from that nightmare scenario of $120 a barrel. The supply chain adapts because it has to. When one node shuts down, even one as significant as the southern Iraqi fields, other global mechanisms kick in to balance the ledger. Whether that's through unsanctioned Russian flows, increased output from alternative producers in the Americas, or demand destruction. The system is engineered to prioritize consumer stability over geopolitical purity.
Let us test that engineered stability by looking at the most critical physical choke point in the global energy system, the Strait of Hormuz. We must pivot to the imminent threat of transport blockades. We can look at the explicit statements from Ali Larijani, the Secretary of Iran's Supreme National Security Council. He stated unequivocally that security in the Strait of Hormuz is impossible as long as the war continues. You cannot simply dismiss this as mere rhetoric when we are talking about a waterway that handles roughly 20% of the world's global oil consumption.
But we have to look at whether they actually have the capacity to follow through on those threats anymore.
The threat itself does the damage. The risk premium currently built into global oil prices is entirely justified because the threat to this vital consumer lifeline remains active and existential. Even if alternative supply chains are somewhat fungible, as you suggest, the sheer volume of global energy that must transit that specific, narrow waterway makes it an irreplaceable vulnerability. If the security of that strait degrades further, the transportation costs will skyrocket. The insurance premiums for oil tankers, which are already heavily elevated, will become prohibitively expensive. Those costs are passed instantaneously to the consumer. The geopolitical reality is that the threat of a blockade hangs over the market every single day this conflict continues, and consumers are paying for that fear right now.
I'm sorry, but I just don't buy that. Let me tell you why. We have to separate diplomatic posturing and televised rhetoric from the physical, operational reality on the water. When we look at the intelligence provided by Brigadier General al-Humaydi, the picture is drastically different from what political officials in the region are claiming. United States and allied forces have systematically dismantled the very infrastructure required to execute a closure of the strait.
Systematically dismantled? The region is still an active conflict zone.
Yes, but look at the specific operational data. We are talking about the targeting of over 50 naval vessels and the destruction of 90% of the relevant Iranian naval capacity. 90%. We also have reports of UAE air defenses intercepting 12 to 14 ballistic missiles in a single day, maintaining complete operational security for commercial shipping. The capability to close the strait simply no longer exists in the way it did prior to these military interventions. The takeaway here is that the market is currently pricing in a ghost threat. The rhetoric of closure might make for alarming headlines, but it does not match the physical reality on the water, where commercial maritime trade continues uninterrupted. The military degradation of the threat is the ultimate consumer shield here. The market knows the difference between an angry press release and a functional physical naval blockade.
Even if we assume the strait remains navigable, which frankly is a highly precarious assumption, given the volatile nature of asymmetric warfare, we cannot ignore the macroeconomic fallout and the psychological damage already manifesting across the globe. You call it a ghost threat, but the economic consequences of that threat are entirely real. We have to look at the broader economic stagnation. JP Morgan has issued dire warnings regarding the cascading effects of this energy crisis on the global economy. This isn't just institutional anxiety at the banking level. It translates to real consumer panic.
Consumer anxiety is high, yes. No one is disputing that the mood is grim.
It's beyond a grim mood. We see reports right now that British citizens are already anxiously monitoring their home energy tanks for the winter. They are fundamentally doubting the assurances of their own government regarding supply. That psychological toll suppresses consumer spending, halts economic growth, and drives everyday people to hoard resources. Furthermore, look at the sheer fiscal cost of the conflict itself. The Washington Post reported that the United States spent approximately $5.6 billion on munitions in just the first 2 days of the offensive.
Military operations are incredibly expensive, yes.
But think about what that means for the listener's wallet. That level of astronomical deficit spending ultimately trickles down to consumers through broader economic stagnation, currency devaluation, and persistent inflation. The cost of the war itself becomes an inflationary engine that guarantees the consumer will suffer, regardless of whether a single oil tanker is physically stopped in the Strait of Hormuz. We are injecting billions of dollars of deficit spending into the global economy to secure these lanes, and the consumer pays for that through inflation.
That's an interesting point, though. I would frame it differently. The consumer anxiety you mention and those massive fiscal costs of the military operations are precisely the catalysts driving an unprecedented diplomatic and military urgency to end this crisis. The fear of macroeconomic collapse is actually the strongest motivator for resolution we have.
You think the fear of inflation is going to stop a regional war?
Absolutely. We are already seeing reports of direct communications between figures like Trump and Putin regarding ending the war. Europe has made its stance explicitly clear across the board. Their top priority is avoiding an energy surge to $120 a barrel because they understand it would decimate their economies. The potential for a 3% inflation spike by 2026, as projected in Dr. Abu Kawi's models, is exactly why the international community, across various ideological divides, will not allow this conflict to be prolonged indefinitely. The systemic shocks you're describing are recognized by every major state actor. That is exactly why we are seeing such aggressive interventions, both military and diplomatic, to force a stabilization. The system reacts most forcefully when its core economic engine, the everyday consumer, is threatened.
The assumption that diplomatic urgency will somehow materialize into immediate physical stabilization before the structural damage is done. To summarize my perspective on this deeply complex issue, we must ground ourselves in the unyielding mathematics of supply and the compounding daily costs of conflict. The sheer volume of physical production cuts we have documented, particularly that 70% reduction in Iraq's southern fields and the ongoing structural cuts by Kuwait, creates a mathematical certainty of heightened inflation.
even with the global supply chain adapting the way it has.
Yes, because when you combine this physical deficit with the immense multi-billion-dollar daily costs of the ongoing military engagements, you construct an economic environment where consumer strain is inevitable. While diplomatic interventions and sanction exemptions are notable and I concede that provide some liquidity, they are ultimately administrative maneuvers trying to paper over a profound physical shortage. The risk premium remains high because the structural vulnerabilities remain exposed. For the everyday energy consumer, regardless of how many missiles are intercepted, the trajectory points toward a prolonged period of elevated costs and significant inflationary pressure. The math simply does not lie.
And to summarize my position, I maintain that focusing strictly on regional production cuts and the literal barrel count in the Middle East severely underestimates the highly adaptive nature of the modern global economic system. The targeted, aggressive military degradation of the threats to critical shipping lanes is an undeniable success. This is evidenced by the destruction of the vast majority of naval capabilities threatening the Strait of Hormuz, which ensures that the physical arteries of global trade remain open and functional.
Assuming no new capabilities are introduced.
Based on the intelligence we have right now, the capacity is degraded. When you combine this military stabilization with highly pragmatic supply exemptions, like the routing of Russian oil to India to relieve global demand pressure, you see a coordinated, systemic effort to prevent the worst-case stagflation scenarios. The global market, backed by state actors desperate to avoid a recessionary spiral, has constructed a resilient defense mechanism. While prices may fluctuate and insurance premiums might temporarily spike, the catastrophic shock to the everyday consumer is being actively and successfully managed away.
Despite our divergent interpretations of just how resilient this system truly is, there are vital areas of convergence in our analysis today that our listeners should take away. We both recognize that the geopolitical risk premium is a heavy, invisible tax currently punishing everyday consumers. There is no denying that the anxiety in the market translates to real costs at the pump and in home heating bills, as we see with the panic in the UK. Furthermore, we are in complete agreement on the economic tripwire identified in the data. The $120 per barrel threshold represents a critical, undeniable danger zone. If prices sustain at that level, it would likely plunge the global economy into a severe recession.
Exactly. That number is the red line for everyone involved, and it is vital for our audience to reflect on the necessity of viewing consumer energy prices not just through the narrow lens of local supply and demand at their neighborhood gas station, but as a vast, highly complex web. It is a web of global military realities, strategic petroleum reserves, and diplomatic pragmatism. Moving forward, the true test of this system's resilience will be found in the physical data. Listeners should continue to monitor how the physical infrastructure and security in the Strait of Hormuz hold up against the diplomatic and political rhetoric coming out of the region. That gap between what is said on television and what is actually happening on the water is where the future of the energy market will be decided.
Indeed. We leave it to you, the listener, to weigh these perspectives and determine whether the global market's layered defenses, both military and diplomatic, are truly strong enough to protect your wallet in the months and years to come, or if the structural deficits and compounding costs of war will ultimately break through those defenses. Thank you for joining us for this Friday summary. We will continue to follow the data wherever it leads.